Well, hello and welcome to Trading Blows from TraderX. Another busy show this week as we reach the halfway point of 2023. We have a look back at some of our key takeaways from the first 6 months of the year and also discuss what's likely to drive markets in H2. And we'll also dig into some of the events of last week as well. A hawkish surprise from the Bank of England and some softening of some key economic indicators, which may be the first signs that some of the policy tightening we've seen over the last year or 18 months is starting to have a little bit of an impact. Without further ado, let's get into the show. So another busy week on Trading Blows. Let's meet the panel. I'm not going to get into the rules because I think everyone knows how it worked by now. We'll go head-to-head over 4 rounds. We'll score points for a great answer, points being chalked off if any dispute is raised, and then Dick will end up losing at the end of it. On the panel this week, Arno Venter, fresh from an argument with his barber down in South Africa. Adam Linton, head the European desk at Newsquawk. And last but by no means least, Mr. Richard Matthews, who is thankfully dressed much smarter than when I bumped into it last week. With that said and done, on the panel on the show, let's get into the first round. So I want to start, when I've finally found my notes, with the Bank of England this week. The old lady of Threadneedle Street surprising markets with their decision last week. Dick, let's go to you. I don't want to get your blood pressure too high too early, but I mean, you must have been as happy as a sandboy last Thursday with the BOE raising rates by 50 basis points. It seems that Andrew Bailey and co have obviously been watching this show and listening to your protestations and taking heed of what you've been saying at last.
I'm very relaxed, actually. We normally record these shows in the morning. It's the afternoon. I've had a very pleasant lunch, so I'm just chilling out now. Not even the thought of Andrew Bailey can upset me. Although I do note that my favourite member of the NPC is talking later, Tenrero. So that should get the blood pressure through the roof when she opens her mouth. Yeah, I mean, the inflation figures were pretty disastrous last week. I think he had to act. I think there's a lot of political pressure on him, and I know they're independent. Thank you, Gordon Brown, for making them independent. But I think the political pressure possibly told on him. 7-2 vote. Better late than never, I suppose. You know, I read somewhere that's a bit like the ref giving a dodgy penalty and then he putting it up later on in the game, giving the other side a penalty. It's just like, almost to me, he's overreacting, funnily enough.
Well, some people are never happy, are they? You know, for months, they need to do more. They need to do more, and
no. If I just sat here and said yes, I'm happy, how many points would I get?
Well, you won't get many anyway, so it's rather academic.
Yeah, we saw inflation over here. We've got pay rises. I've noticed that the government's now thinking of ignoring the pay review for the public sector, which I think will go down really badly. Figures that came out today actually weren't too bad on inflation, on food price inflation. He's got a lot of flack for having moved it. All this mortgage bubble, as Michael knows, I've had a spat with Martin Lewis talking about mortgages. Yeah, and then they go and actually undo half of what the Bank of England's done by offering forbearance on interest payments, which of course is inflationary. More talk, another couple of base rate rises. I'm not so sure we'll get them now. I think we might get another one in August, and then he'll just sit back and watch what happens. I fear, actually, that we are going to teeter over into a recession. The figures here in the UK don't look that good, although we got GDP out on Friday, I think it is. You know, things stop. Yeah, just seems a little bit softer. I actually went shopping in my hip hop grandson last week. And everywhere we went, the shoes were discounted, shirts were discounted. Maybe because they're just crap, but there certainly were discounts around. I also actually saw that Travis Perkins are cutting the price of timber, so obviously the housing market's starting to hurt, which will hurt all of us. So, you know, he's done it. He's got it out of his system. Thank God for that. Should have done it 6 months ago and shot the market. We'll get another one. I was looking for a terminal rate of 6%. I'm not so sure we'll get it now.
Yes, I was going to say that terminal pricing, I think it's almost up at 6.25%, or at least it was when I last looked. Adam, I mean, you were squawking the decision live while you were trying to work out how many thousands of basis points the Turkish central bank had raised rates by. What do you think? Is this just panic stricken by the BOE at this point, or is this actually justified because they are so far behind the curve?
I think this decision was more of a political credibility one than necessarily an economic one. I think they obviously saw the UK inflation figures and they panicked a bit and felt the need to kind of act accordingly. I think, when you kind of break down what's going on in the UK, we've talked about this at length, that, the two main inflationary shocks which the UK felt have been external to it. So that's the lingering effects of COVID, and then we've also had the Russia-Ukraine conflict. I think also there's some structural issues in the UK, and then we didn't have as much generous energy support as some other nations had. And when you throw Brexit into the mix, it was always going to be a tough, backdrop for the bank to kind of deal with.
Do we take a point off for the B word?
What? The inflationary impact of putting up Barrow as your main trading partner and burdening small businesses with bureaucracy.
It's like
passport.
That Brexit. No, but yeah.
I stopped you in full flow there.
That's all good. No, yeah. My point is, though, I think there's a lot of structural issues in the UK, and I think whether they had done an extra 25 here or 50 there, I don't think it would have really made much of a difference. I mean, the ECB, they're way, behind the curve relative to us, but their data is actually kind of turning a little bit. Ours, on some measures, is, if anything, going the wrong way. I think there's a lot of externals that the Bank of England ultimately fighting against, which they can't really control. I mean, yes, they could have jacked rates up to maybe 10%, but in the real world, that would never happen. I think what they've ultimately been doing is they've just been playing for time these last few months, but unfortunately the data just hasn't really kind of gone their way. We know that energy inflation by Q3, Q4 is likely to turn negative. And there's also this mortgage time bomb, which is really going to have quite a big effect on the UK economy. So you've got 7% of the stock of total fixed rate mortgages. They're expiring every quarter for the rest of the year, and it goes to 6% next year. So I think ultimately there's an equilibrium interest rate here, which is going to satisfy that. Whether that would have been 3%, whether it would have been 4%, 5%, we don't ultimately know, because a bulk of the tightening is ultimately still in the pipeline, which is what I think the bank was trying to kind of communicate before. I think the problem they've had is they're not communicated particularly well, that these kind of headwinds are kind of coming down the track. The problem is now is, have they kind of panicked and we're going to go for a regime where our inflation prospects are too high relative to peers, to one where we may be able to control inflation, but now we're just absolutely decimating things on the growth front. I understand, there's arguments that from an inflation psychology standpoint, that yes, they needed to do something. But, when a mortgage crisis is at the front page of the news, I'm pretty sure, a lot of those bets, probably would have fallen away at some point. I think, they need to begin to be a bit more cognizant of kind of the growth outlook. I think near term, there's not a lot to be positive on for the UK. And then over the medium term, with successive random governments with no real kind of sustained path for growth, I think, and we kind of saw some warning signs from the PMIs the other day. I think they're at a risk of going too far. And if they kind of possibly had have held their nerve with these mortgage refinancings coming, we could have maybe engineered a soft landing. But I think now we're just going gung-ho, trying to get a hard landing, and they've kind of caved under the pressure.
Yeah, and I think the point you made right at the start there around this being a credibility problem is really key, because, even if the BOE had wanted to go for a smaller hike or even no hike, they have such little credibility that the market would really have punished them if they tried to go down that road.
I think also as well, it's like a communication with the public, because the public think that if inflation coming down is prices actually dropping, not the rate at which those prices go up. So clear all round, from government, from central banks, there's been an absolute disaster when it comes to inflation. A, what it means. B, the means of who actually controls it, fiscal monetary policy. and then what is actually in control of the central bank. So I think in them just throwing 25, 50 basis points, if that's going to fix anything, isn't necessarily going to achieve a great deal.
No, absolutely. And the other point with the public, sorry, Dick, I think actually you made this point last week. Was it 3 or 4%? I think rates have actually gone down. I mean, what on earth is that all about?
That was from the Bank of England decision, mate. Was it from there's one of their Prospera survey or something like that? It's ridiculous.
But it's not the Bank of England's job to educate people, or the government's job to educate people, or even that wonderful Martin Lewis's job to educate people. It's bloody schools. People are so stupid they can't understand how inflation works and what it does to prices. It's not down to the Bank of England. And I will defend the Bank of England on that. It's very rare for me. But you are right, their communication is absolutely horrendous, isn't it? Don't ask for pay rises. And he's on what, half a quid a year or something. Oh, no. Yeah. Ask for pay rise. It's just ridiculous.
And that's just his food bill. Arno,
our host has taken no prisoners today. If you felt I've had a dodgy haircut, you're done for.
The dodgy haircuts. Arno, let's bring you into the show. You've been suspiciously quiet so far. I think it was when you were last on, actually, you turned short sterling after the labour market numbers that we had out of the UK. Obviously, cable got up to 128-ish. We've pulled back a little bit. Are you thinking that, as Adam said, we're now going all in on a pretty deep recession, a hard landing, and that you would be maintaining your short sterling position? Or has the BOE's hawkish surprise made you rethink that a little bit?
No, I think still short sterling is the way to go. I think the BOE decision, like the guy said, really felt like a panic move. Apart from the two dissenters, which, after that type of inflation print, let's not go into them, but 7 of the MPC coming out, going for a 50, that shows you that they got a little bit spooked by that inflation number. And I mean, as they should be, they should have been spooked, like Richard had been saying for so many times, they should have been spooked, 100 basis points away. So the fact that they are doing this shows us that they are panicked. It shows us, like the guy said, that they are trying to do this to try and, recover some form of credibility, the little bit that they might have left. They should have done a lot more earlier. So this is feeling like a little bit of a catch-up move from them. Now, I don't think they're going to get anywhere close to what's it now, the 6.15% that the markets are pricing in. I think the damage that this hiking cycle will do to growth, the impending mortgage issue that we've been talking about en masse recently, I think all of those things combined, I think there's going to be some real problems for the economy going forward. Now, we spoke about the inflation print the last time we were on, saying that we think that if we get a higher inflation print, that's going to be negative for sterling. And last week, that was the reaction that we played, getting long euro sterling on the back of that, trying to take some advantage of that. So I think that's played out, and I think that's the reaction function that we can expect from sterling in the months ahead. If inflation goes higher from here, normally in an environment, we spoke about this last time as well. Normally, when inflation goes up, yields goes up, interest rates goes up. Normally that's positive for your currency. But in this current context, I don't think that's the case. I think the balance of risk is skewed towards the downside for sterling from now. What I'm finding a bit challenging right now is just finding the best way to express that view. We've had a couple of short-term trades on sterling, but from a medium-term perspective, there's just so much going on in different currencies right now. It's difficult for me to pinpoint exactly which one to focus on. Maybe it's best just choosing something like a basket trade, instead of putting all of your eggs in one basket looking for one particular counter currency. Maybe it's better looking at a bit of a basket short. Maybe that could be the right approach. But like I said, right now I just don't see the positive angle for sterling in this. And what I like about that is that there's a couple of banks out there that actually do think this should be massively sterling positive. I read an interesting note from Goldman yesterday saying that, they know people are saying that the growth issues is going to be a negative driver. They don't believe that. So I like when not everybody is on board with that particular view. But I struggle to see how everything will just be fine. Even if they go once more, let's say they get to 5.5. Remember their growth projections that they were looking at. When was it? In May. If they were assuming a nominal interest rate of 4.5, if we go 1% higher, the damage to growth could be massive. So I don't see the positives for sterling right now. So definitely staying short that. Just like I said, finding it difficult to find an adequate pair to express that with. So maybe a basket play could be better.
No, I think that's your point on growth is an interesting one. I think it was Bloomberg said that if we get to 6%, it will take something like 2% off GDP. So you're looking at that as a kind of benchmark and then working either side of it. Speaking of the economy, let's get into that in a little bit more detail in round two. So I want to talk about the PMI data that we had out on Friday. I do feel a little bit of a fraud talking about that, given that I wasn't actually at my desk for it and I was enjoying myself at the tennis instead. It really is I know it's a tough life at the moment, Dick, isn't it? There's a lot going on here.
Was Pepperstone sponsoring the tennis?
They were, actually. Yeah, I didn't have to pay for a ticket there, unlike Murray.
That's how you take all your friends to it.
Do you want to let viewers know why we're recording on a Tuesday, not the normal Wednesday slot?
Yeah, I probably should, actually. That's because, again, I'm shirking my responsibilities tomorrow. I'm going to the cricket at Lord's tomorrow, which was a much better offer, actually, than sitting in a meeting room under a burning hot light talking to you guys. But, depending on
what you wish for. Knowing who you're going with. And I presume next week there'll be no show because it's Wimbledon.
No, there will be a show next week, and you might even be on it. Right, let's try and get this show back on the rails, shall we? The PMI numbers we had last week, they weren't particularly great. The manufacturing PMIs in particular were very, very soft indeed. Adam, let's start with you, because I know you definitely were at your desk, because I think you were probably squawking them. What's the takeaway here? Is this a sign that things are really starting to roll over and this lagged effect of tightening is finally coming through after 18 months or so?
I think, a note of caution, because I know if our good friend Ryan was here, he'd be reminding us, that PMIs are very much just a finger in the air kind of exercise for, these purchasing managers. And if you take something like the UK, they exclude retail, they exclude government spending, and they can exclude construction. So they're only looking at 50% of the economy. So, from that perspective, you do need to take them with a real pinch of salt. But if, take them at face value, what we've kind of seen from the figures, then, part of the narrative at the start of the year was, yes, the manufacturing sector was in doldrums, but the services sector was kind of holding things up. And we've kind of seen that play out with some of the services inflation we've seen since. These latest reports, obviously we saw the Eurozone services still held above 50, so did the UK, but, the rate of expansion is definitely pulling back. We saw the French services PMI, that was below 50. So a potential definite turning of the tides. And then we saw the German IFO data on Monday follow this all up. And I think now it's a question more of not if Germany goes into recession. It's a question of how bad the recession will be. I think, whether this is interest rate lagged effects or something broader, I don't think isn't necessarily the lens at which I kind of look at things. I think if you take the Eurozone, part of the feel-good factor at the start of the year was the China reopening. And as we've kind of seen that stutter, I think it's inevitable that, that will kind of weigh on things. I think trying to disentangle interest rates and that kind of effect is not really kind of the way I look at things. I think from my perspective, I'm kind of more thinking of, okay, well, what's the actual kind of policy impact of all this? And I think one kind of nuance I've kind of been thinking is that we've kind of seen central banks now move from focusing on their models and kind of outlooks to actual realized data. And I think the real warning sign from this is that the sooner that the service, the PMI data and survey data kind of turns, I think that could potentially be emblematic of how deep a downturn we could get. Because if the central banks are going to keep tightening policy, keep things tight, and wait for the actual data to be released and show that things are turning, that creates a huge lag between the two. And therefore, I think it could show that, any downturn we do get, the sooner these data points do start turning, it could potentially be, worse than, things otherwise could have been. So that's kind of the way that I've seen it. But obviously, you kind of need to see the broader trend of these data releases and think about the policy response itself. I mean, there is a world in which service inflation, if you're at the Bank of England, you see the services PMI pulling back, is that a bad thing? Not necessarily. We know it's been a huge headache for them on Threadneedle Street. So if a bit of froth out of that sector's, beginning to kind of come out a little bit, then maybe it makes their life a little bit easier. And the conversation we had the last round about the potential hit to growth, that might not necessarily be as bad. It depends what the policy response is.
Yeah, absolutely. I would 100% agree with that. And I think your point on watching for a trend is a good one as well. And also remember, these are flash PMIs. We will get the final data in a couple of weeks when we may see some modest revisions. Arno, what are your thoughts on some of the figures we've had out over the last week? We had some the jobless claims number out of the US as well, above 250 for a third week running. So are you starting to get a little bit more worried about what's going on, or do you think a lot of this is just kind of noise at the moment in the figures?
Well, I mean, before we get to the cyclical aspect of it, I think what's always handy about PMIs, if you're a CFD trader, a retail trader that's able to take advantage of jumping in to the markets very quickly and jumping out very quickly, flash PMIs can offer some fantastic opportunities.
You can get in and out in a flash, can't you?
Exactly. So the good thing is, there's some opportunities to be had, on the growth side. I think we'll get to that in the next session, but growth numbers are going to be critical, I think, for how the markets will be trading FX in the weeks ahead. In terms of the bigger picture, every cycle is different. We know that, but the eventual impact of rate increases is really different in the end, right? Like Adam said, you can. There's going to be lagged effects always, but at the end, it normally ends the same way. So I think the problem that a lot has had with this cycle, try and compare this to so many of the others we've had, is that inflation isn't normally the problem that we have right now. Obviously, going back to the 70s and 80s it was, but for most of the recent cycles that we've had, we haven't really had inflation as this type of problem, so it makes it very difficult to compare the two. But, this cycle of rapid rate hikes has been one of the most aggressive ones we've had on record. And it's happened. The difference is it's happening everywhere, right? We're having central banks tightening everywhere except China, So I think you can't have your cake and eat it. Basically, all of this tightening we've had will eventually catch up to economies, as they always do. I think the markets are broadly in line with that view, though. I think where a lot of the differences comes in is in the extent to which that will impact growth, right? So everybody expects growth to slow down. Like Adam just mentioned, central banks actually want that to happen. The question is, will it be the type of coyote running off the cliff type of scenario where suddenly everything just, the music stops and it craters, or will it be a gradual slowdown? If we get a gradual one, then I think that's something that the markets have already to some degree priced in or expected or have been expecting over the past couple of weeks. So that's, I think important to mention as a start. We know that economic changes won't happen in a straight line. So I think where this pitches in with the recent data that we've had is everything we've just mentioned has been mostly those noisy indicators, right? We've had, like you said, jobless claims now coming in high for the third week in a row. We had it up to, I think, 262 3 weeks ago, then again 262, then 264. The IFO very similar, the PMI is very similar. So it's very noisy indicators. But I think what we're seeing right now is that we are seeing signs of that broader slowdown basically just being confirmed, right? I think places where it gets very interesting right now is Germany, where you have both growth and inflation slowing at a pretty steady pace. So, for equities, I think when you combine that with how far equities have gone in a very short space of time, when you combine that with things like month-end flows, quarter-end flows, whether this is the start of a turn in the economy or not, I think you will do well at this stage where we are, just to potentially play things a little bit more defensively, especially in the current context that we're in. Whether the data confirms or continues to deteriorate, I wouldn't be surprised if that happens, but I also won't be surprised if this is short-term noise and things look better again in the next 3 weeks. I think right now, given how far things have gone, the context itself lends you to be a little bit more defensive in the way that you play the market. So if you are long, it might be a good idea to maybe consider things like hedges. If you're outright selling, maybe this is appropriate for you to look for opportunities to do so. But personally, I'm not using this information as a broader view of where I think things are going. I think right now you're better off trading that, like you said, in the flash, in the moment, with short-term trades. I think that's the way to trade these right now, as opposed to looking for these monster trends to come out of this. I think that's going to cost you money if you try to trade these events like that right now.
Yeah. No, you were very close there, Arno, to getting a point knocked off for mentioning quarterly rebalancing flows. It's a perennial excuse of any analyst who doesn't really know what's going on. It's just a nice narrative to
it's a good fallback always.
The best one is when it's the start of a new month and people say redistribution, month.
Yeah.
I should have gone with that.
Dick, let's get on to you. A bit of a curveball for you. Both Adam and Arno mentioned it. So what are your thoughts on what's going on in China? It does seem that actually a lot of the weakness that's coming through is stemming from this reopening narrative just kind of fizzling out entirely, doesn't it?
Yeah, I mean, it was a complete non-event, wasn't it? I mean, it's probably, I don't know, I guess you could put it on par with the debt ceiling, which I don't want to lose a point for saying it, but, that was a non-event. What is going on in China? Well, the one thing's for certain, they're lying about their data. They're starting to play around a little bit. I suspect there's some intervention in the currency going on. Everything, all is not well, that's all I'll say, which is a worry for the West. I'm going to be the warmonger as normal. I should imagine that...
Get your tin hats on.
Get a tin hat ready. Good war will sort out their economics. I wonder how concerned they are with what's going on in Russia as well, whether she's keeping an eye on that. So, I think certainly a lot of people are reliant on China. It's disappointed. But just going back to the earlier points, PMIs, I think, are absolute nonsense. I just think they're a waste of time looking at them. And hats off to Arno, if you're sharp enough and quick enough to trade on a flash PMI, that's those days have gone for me. Because if someone asks you, you can ask them on a sunny day and they'll be more optimistic than they are on a rainy day. I just think they're a really, really strange, a strange indicator there. And a couple of other points I wanted to make, and actually I probably will lose a point for saying this. It is month-end, quarter-end, half-year end this week.
Oh, yeah, done. Now you've been warned.
Yeah. It's a market. To me, it's a market. It is a market to avoid. But what I'm interested in is that this narrative that we're getting near the top on central banks. That's it. We've had such quick interest rate rises, never seen the like before. I think you find that Volcker moved them pretty damn quick, and he moved them until he broke the market. In the area of the old phrase, whatever it takes, I actually think it's now whatever it breaks. They are going to wait until we're pushed into such a deep recession, if not a depression, before they do anything. Historically, inflation has 2 or 3 peaks, and we've only seen one. Certainly in the 70s and 80s, the big inflationary years then, you saw 2 or 3 peaks in there. And I think people who think this is all over by the shouting are massively wrong. So I'm afraid I'm really, really, I'm pretty depressingly pessimistic long term over the markets. But the data's not too bad, is it? Really? But good to see Bank of America doing technical analysis.
Don't. Honestly.
What is a cup and handle when it's out of, I've no idea what on earth they were talking about. I presume it was a joke, wasn't it?
I genuinely don't think it was a joke. I think this is what happens when you let the summer interns onto the research desk.
They're about one report away from doing astrology at this rate.
when you get things wrong for long enough, you just revert back to technical analysis. I mean, they're just going back to their roots. That's it.
Astrologers were invented to make economists look clever. Not original. That was Galbraith who said that. The only thing I would be watching, 2 things actually. I'd be watching the 2s10s at 102. I think they were last night. You've all got screens in front of you. I haven't, which is indicating a huge recession and money supply. And I keep harking on about money supply, but I think that's a real key one. As that drops off a cliff, that will be the point of recession. And if central banks aren't looking at that, well, who knows what they're looking at?
Well, I think that's the point. Anyway, nice and cheerful as ever there, Dick. Thank you very much for that. We're halfway through the show, so let's get into the third round. So we're not only halfway through the show, we're halfway through the year as well. Where have the last 6 months gone? Absolutely flown by. Plenty's happened. We've had, well, of late, everyone's gone mad over AI. We had regional banks blowing up all over the place. Credit Suisse finally failed, as it's been expected to do for so long. It was teetering on the brink forever. Inflation has started to roll over. We've had, well, apart from here, sadly, we've had this whole debate, or we had, I should say, this whole debate around a hard landing, a soft landing, or no landing. And we've now got, as we said, investment banks doing technical analysis on macroeconomic data points. Arno, let's kick off with you. I mean, what are your biggest kind of takeaways from the first 6 months of the year in terms of, you know, what we've learned and what may have surprised us compared to our expectations when we were sat here in December last year or in January?
I think firstly, you know, when apart from the themes that, you know, I didn't see coming, like the AI boom and the regional bank failures, apart from those things, you know, focusing on the stuff that people knew about or should have known about when they happened, I think what this has taught us is that we cannot count on the market crowd to get anything right. You know, coming into the start of the year, markets expected the dollar's demise and the yen resurgence. We didn't get that. Coming into the start of the year, everybody expected China to be this massive, you know, growth story, the big rebound powerhouse. We didn't get that. At one stage, the markets were sure we're going to get a recession. That should have, you know, started by their estimates in 3 days' time. Probably not going to get that. Markets were sure the Fed will be cutting rates. I think twice was the price at some stage, 2 rate cuts. Now they think the opposite is going to happen. At some stage, the euro was everything. You know, European equities was the place to be. Now that's not anymore. You know, at some stage, I think the markets were, you know, they were believing that, you know, equities will revisit their lows at the start. I think end of quarter two, start of quarter three, somewhere around that level. Right now, that looks unlikely. So I think the biggest takeaway
at JP Morgan, Morgan
exactly.
Stanley, forgive me, he's still bearish.
So the biggest, I think, takeaway for the first half, at least that this has just once again shown me, is that consensus is usually wrong. You know, even more so when the markets get crowded and complacent in any type of direction. It's also an important reminder just how useless, you know, forecasts are even just a couple of quarters out, you know, to say that, oh, this and this is going to happen in Q4. Look, it's like NFP, you know, guesses, you know, it's anyone's game. There's just so much that can happen and often do happen in the in between, which means that staying nimble, especially in this type of challenging situation, I think staying nimble is the best way to play right now, especially in these types of economic situations. And I think that's really good news for, you know, retail traders out there. You know, I spoke about it earlier as well. You know, it's challenging for retail traders to carry positions on a CFD for anything, you know, if you talk about 6 months, 12 months, that's very, very challenging. So being in an environment where you are rewarded for, you know, rather trading nimbly and trading short-term focused, I think that's very, very good news for retail traders right now. You know, in this market, I think we are still in a trader's market, not an investor's market. There's obviously a lot more smarter minds out there which will always, you know, get all the turns right. But for us normal traders out there, you know, I think right now, what I've learned is that we are still in a trader's market, not an investor's one right now. And it's best to stay humble and stay nimble as far as you can, because, you know, if you join the crowd, you're gonna lose money at some stage.
Yeah, and it's funny you mentioned that. I mean, all those people who get every trade right have just retired as submarine engineers, and they've now gone back to being Russian military commanders posting on Twitter. So, you know, it's all one and the same, isn't it? Adam, I want to get your thoughts. I mean, you know, so much has happened. Is the big theme the fact that there hasn't been a big theme? You know, it's not as if we've all been able to latch on to, for example, last year, high inflation, who's going to hike rates quicker and to a higher level, is the big takeaway that markets have just kind of not had a narrative on which they can constantly fall back on.
Yeah, I think that's fair. And I think, if you look at some of the contradictory signs within the market, I think that's probably true. I mean, I can't believe that Arno didn't mention one of the big surprises for you was the debt ceiling being resolved. It's absolute miracle that thing that always gets sorted got sorted, despite Wall Street telling us it was, the end was near. That's that's phenomenal. But on a serious note, I think when you kind of look at how the year's kind of unfolded, I think in terms of kind of the way that I view things, I think that, growth has obviously clearly held up better at the start of the year than many people had thought. I mean, we saw that Bank of England monetary policy report in November, which I think had 5 consecutive quarters of recession, which obviously in hindsight is beyond ridiculous. But I think, you saw the Eurozone hold up better. Part of that was an energy story. Part of it was a China story. And then I think, if one theme, if you like, is possibly the fact that interest rates have kind of been possibly more elevated than a lot of people would have expected them to be. I mean, a lot of people were positioning for Q3, Q4 rate cuts from the Fed. Clearly, they haven't materialized. And that's been a theme we've kind of touched on quite a lot, whereby, I've said for a while, the Fed was here, the market's here. At some point, they're going to have to meet somewhere. But, I think the real surprise beyond kind of interest rates is how well the market's handled it. I think if you knew the repricing that you've seen at the Fed, and then someone said by June this would have happened, oh yeah, the Nasdaq's going to be up 28% year to date, you'd have said no, you need your head checked a little bit. And part of that is an AI story to an extent, but as we've kind of touched on before, there's also an element of kind of safe haven appeal now for these Nasdaq kind of tech giants. And we saw that during the Fed, with the banking crisis, where the Fed tightening, they're always going to probably break something at some point. We didn't necessarily quite know what was going to break and how. And I think one of the key themes is in going forward, this is also important, is what role do these tech companies kind of play? Because if they're kind of desensitized to interest rate risk and they're kind of seen as safe havens in these kind of times, then, that is definitely a theme that we need to kind of be aware of. And we saw that play out during the banking crisis, whereby liquidity expanded and a bulk of the year-to-date gains, the S&P 500, took place between that March period and that April period. And, the main theme there was that, yes, interest rates were going up, but the Fed and Treasury had some liquidity measures on offer. They unleashed them, and it didn't really matter what interest rates did. We still, we soared higher since then, and we've not looked back. So there's not been like an overall macro theme. But I think, for me, if I was to kind of try and piece it together, it'd be resilience would be the word I'd use. I'd be resilience, for growth, resilience for inflation, then resilience of how the market's handled it.
I think that's a very good summary. Mr. Matthews, I saw you playing with your wooden spoon there while Adam was talking. I think we may be awarding that to you momentarily again. What are your thoughts on the first half of the year? In particular, the FX space. I know that's where you reside these days primarily. I mean, we've had a very, very strong performance so far for the pound, which certainly has surprised my expectations. And the yen has been beaten up and beaten up and beaten up some more. What's really the kind of takeaway message that the FX price action has been sending us?
Sterling certainly has been a big surprise to me. I historically don't like it. I think it's certainly the best performing currency of the G10, isn't it? In the first 6 months.
Yeah.
The only biggest surprise is that Ryan Paisley called it correct, of being a bit of sterling. It's great to actually admit that he was right and I was wrong. I don't think there's any real direction. If you look at the actual quantum of the moves and stuff, it's pretty tight ranges we've been trading in. The yen is a disappointment. To me, I actually quite like the yen. I think it's stable, but I suspect a lot of people like myself were expecting a little bit of a policy change at some point. There are signs there's inflation there for the first time for God knows how many years, 20 odd years. So maybe there will be a policy change. Sooner or later, they'll come in, or the Bank of Japan will come in and give it a smack. Really, really difficult. I think resilience actually is a really, really good answer. I think the markets are incredibly resilient. People are looking for the Fed. What did we start off with? We started off with a pivot. By this time, beginning of the year, we're expecting the Fed to pivot and start cutting rates in June. And then we're looking for a pause, and now it's a skip. And sooner or later, people actually realise they ain't for cutting. Rates are here for a long time. You're going to get higher for longer, not higher for longer, as Helen Thomas always says. I'm surprised how resilient the stock markets are. The S&P, I read somewhere that the biggest 15 on the S&P were up 34% this year, whilst the median only up 1%. So, it is big companies driving these indexes, the same as big tech. AI, I don't know. I'm not sure it's as advanced as people say. I just think it's supercomputing at the moment and analysing.
Well, you've only just moved on from a typewriter, haven't you? So
I have. I've still got a telex machine and a fax machine. I do actually really. I'm not convinced that the AI is where people think it is as yet. It will get there, and I think that'd be really, really scary. Looking back over the last 6 months, amazing to me how the market shrugged off Credit Suisse almost without, hey, it's gone, let's move on, next please. It's a big bank and an important bank. That surprised me. But at the same time, how fragile some of the banks are and how shockingly complacent they were in their hedging policies. And they just didn't see what was coming. They couldn't take the hit. So that's the fragility of the banking system. The second tier banking system in the States was a worry, and I think there are still problems there. But last and not least, the one thing that didn't surprise me in the first half of the year was that Bailey's an utter clown.
I was slightly worried what word was coming there.
I did stutter. I was going to talk about our Chancellor, but I didn't dare. Jeremy, whatever his name is.
I'm glad you chose that C word and not another one, which I'm sure you're thinking.
Yes, so am I. Right, before we get into trouble, come on, move us on. Right, so we've looked back and we've avoided a Freudian slip from Mr. Matthews, thankfully. Let's look forwards. We've got 6 months of the year and 3 days to go at the time of recording. What do we think is going to be the big story going into the second half of the year? I mean, as we've said, I think H1 has taught us about being nimble and the surprising resilience of the market. Adam, let's start with you. I mean, what are the 2 or 3 things that you think are really important for everyone to have on their radars as we move through the next 6 months or so?
Well, I'm sure when we sit down in 6 months, it'll be something which hasn't even been discussed on this show. But in terms of kind of, top line things, I think we're very much gearing up with, this how sticky is inflation going to be and what's the subsequent policy reaction from that. I think, if you take the Fed, for example, at the moment, the dot plot is saying 225 basis point rate hikes. I think if we do get that, the context in which we get them will probably define the second half of the year. If they need to do a Q4 rate hike, then I think, that'll be the main takeaway when we're talking again in December. That could have more of an outsized impact on the equity market as those earnings, earnings forecasts will need to kind of be revised lower potentially. And then any rate expectations for Q4, they're probably going to need to be revised higher. I think, and then also, when we kind of get into that, central paradigm, I think there's a big chance of divergence across central banks. I think that could be thematic. I think we've kind of all hiked in unison, more or less, but then I think you'll see a bit more of a divergence between some of the central banks. Some will think, they've kind of declared victory, they've reached terminal. Others will kind of keep going. And I think that could open up some opportunity in the FX space. And I think within that, the Japanese yen's quite a bit of a wild card. I've been saying for a few months now, I don't think the BOJ are going to do anything material. They may tweak yield curve control a bit, but given the hiking cycle we've seen elsewhere, that just doesn't, that's like a stone in the ocean, what they're saying is. And then with that in mind, does dollar yen get to 150? That could be a key theme for the second half of the year. Obviously, Japanese officials will try and get in front of that, but I'm not too sure they can get a real sustained reaction on that front. And then I think, it's also the growth outlook aligns with how inflation is. I think if, growth should probably turn lower, but if inflation is sticky or if inflation pulls back, could be two very different things. I think, in a world where growth does turn, but inflation does kind of pull back, I think, central banks can tweak to kind of ease financial conditions a little bit more. But if inflation's sticky, then I think that's kind of the worst of all worlds. And that could be, the key theme for the second half of the year. I think, and a couple of other top line things is this tech leadership. Does it continue? Do we get a rotation to some of these small caps? I think maybe not if, the real economy does begin to suffer. And then, one thing I was also cautious about, geopolitics is one of the noisiest themes in the markets. But, I think that's more bark than bite. I think we saw from Russia over the weekend, we almost had a military coup. Energy didn't care. The market didn't care. I think I'm kind of very skeptical about the ability of geopolitics to really move the tape. And I think that'll probably be the same case in the second half of the year.
Yeah, it's interesting you mentioned that. The market has just kind of shrugged that off entirely, almost as easily as it shrugged off Credit Suisse, I guess. Incredibly comprehensive answer. Dick, what on earth can you add to that in terms of what you're watching? I can see you shaking your head in dismay there. What are you looking at over the next couple of quarters?
I'm going to be staying outside the Bank of England on the 5th of July, which is Tenray Row's last day.
Oh, I'm
going to be standing outside celebrating, saying bye-bye. Don't bother about shutting the door. We'll do it for you. All joking aside, geopolitics, it was quite interesting how that was shrugged off. I think that's a really concerning turn of events in Russia. You're not going to get an easy change of power there. You're not going to get a nice version of Mr. Putin taking over. The odds to me are that you'll get a nasty version of Mr. Putin taking over. To me, they're all a bunch of gangsters. I'll probably get a knock on the door and a cup of tea from a Russian.
Don't stand next to any windows.
Yeah, someone to put the ladder there. Yeah, but they are a bunch of gangsters. And I think to me that's a really concerning thing. It's like choosing, what mob do I want the cartel to run Russia, or do I want the mafia to run Russia? I think that's a really worrying thing. And it's been a nightmare scenario for so many people of nuclear weapons falling into the arms of terrorists. That is what will happen in the eventual turnover and Putin going. I think it's really worrying. That, to me, could well be the driving factor over the next 6 months. Real estate, commercial real estate and real estate generally, I think loans are rolling over there, got to be renewed, as we touched on the mortgages earlier on in the UK, but I think commercial real estate must be an absolute nightmare. Look at the number of empty offices there are in the city. Who's ever going to fill those? And
HSBC.
Huh? And you can't turn them into flats because they have only one set of windows at the front, so they're absolutely dreadful as flats. But I think that's a concern, and the banks who've got these loans on the books, great, will have the office block back. So, it's valued at X million on our books, and they come to sell it. Oh dear, it's gone. So to me, that's certainly one thing I'd be watching. UK politics, I think, could get very interesting. We're going to have an election next year before we know where we are. If we're not campaigning already, we'll be campaigning. I know that Sunak is right on. I've 100% got this. The man is, he's just a jumped up civil servant idiot.
In short trousers.
And he hasn't got my vote. He's upset me about dog welfare. But I think that you'll start seeing that.
You're wishing Corbyn will come back, aren't you, Dick?
Yeah. Well, he's an Arsenal fan, so I love him. No. I think that this will start to play, and of course you'll get the worries about the Corbyns and although he's not in the Labour Party anymore, but the hardline left in the Labour Party coming out. So I think that will start to play on sterling. I can't see a reason to buy sterling, I've got to be honest. If I had to buy anything, I'd probably keep long in the dollar just on a risk-off basis. Might see another shock out of banks. I don't know. Is another one going to fall on flat on its face? And I guess, who knows? Who knows? And sooner or later, people will turn around and realise that the Federal Reserve is serious, and we are going to have higher for longer, and they're going to stick to it. Whether it comes out in their minutes minutes due this week or next week, I think. whether that will suddenly people will wake up and see that. So I'd still be nervous of the stock market, because I think that you will get a gradual realization that earnings are going to get hit pretty hard, and the Fed is going to carry on tightening. And as I said, watch out for that second spike in inflation. And it could be that core inflation doesn't go away and it spikes up. So that would be my other major worry, apart from gangster land in
I love how all three of us just jumped in to clarify when the Fed minutes are. It shows we've all really got our fingers on the respective pulse there, doesn't it?
Yeah.
I've no idea.
Wednesday the 5th of July. Wednesday the 5th of July, there, Jude.
There we go. Mr. Matthews has done his research. Arno, let's wrap up the show with you in a couple of minutes. Where do you think the risks lie to the FX market, equities, bonds over the next couple of 6 months?
Well, I mean, after those two answers, I'm not sure what I can add that will add value. I think, on the inflation front, if you take a look at US break-even inflation rates right now, I think, as well as the continued slower than expected, but continued deceleration that we've had in inflation measures in both the US and Europe. I think personally that in the second half of the year, inflation will only be a major theme in those places where it doesn't follow that expected path, right? So Australia would be a good example. Obviously, the UK, we've gone through that with a lot of details. I mean, Canada, we had that big scare in April. They hiked rates because they were afraid. Today, we had a full percentage point drop in headline inflation. Core inflation in Canada is back down below 4% now. So I think as long as that...
Sorry, just to jump in there. Do you know the other thing on the Canadian inflation numbers? I think something like 2.5% of it is because of a rise in mortgage costs. So actual underlying inflation is even lower than that.
And I think that that proves the point. I think as long as we see inflation following that broad cooling that many are expecting it to, at least based on market expectations with break-even inflation rates right now, if we see that path continue, I think the main focus going into the second half of the year will be mainly growth differentials. We mentioned that earlier as well. Basically, where does growth hold up the best and the longest to allow central banks to stay higher for longer? Above the rest. So the one that doesn't break something quickest, they will be staying higher for longer. I think that's where a lot of the differential play will come in. Obviously, if we get inflation scares along the way, like I said, if as long as in those places where the broad theme doesn't play out, that's going to be a big focus. But as long as it starts to cool across the board, even in the UK, it's expected to cool down. We'll see whether that happens or not. But if it does, I think growth's going to be the main story that we need to focus on, especially from an FX market perspective. That's what we'll be focusing on. I also think specifically, this mortgage situation in the UK, I think is quite interesting. It's expected to play out over the next, couple of months. I think that from a UK specific point of view and for sterling, that's going to be a major theme. I think that also means that things that we normally don't pay a lot of attention to, like housing prices in the UK, even though we pay attention to it, but we don't really pay attention to it. I think those types of things will start to get more attention, but as that theme starts to develop. And apart from growth differentials, apart from, the mortgage situation, I think labor data, especially in the US, is going to be a major theme to consider. It has been, to be fair, throughout the year, it has been a major theme. But given the current expectations that the Fed will be hiking again and expected to leave rates much higher for longer, if the labor market, for whatever reason, starts to soften a lot faster than expected, that narrative can change very quickly again. So in a nutshell, I would say the main themes that I'll be watching in H2, or that I think will be, apart from unexpected things, like Dick mentioned, geopolitics and those types of things. Apart from the unexpected stuff, I think growth differentials will be a major one for the FX space. The labor market will be important across, all asset classes. And then specifically for the UK, that mortgage situation, it's going to be interesting to see how that plays out. Because, right now, I'm bearish sterling on the back of that. But, what does the government do? Do they do anything? If they do more, will that, keep growth high? If that's the case, what will that do to inflation? So I think that whole theme will be interesting to keep track of for sterling for sure. But those three, I think, is the main themes that I'll be watching in H2.
Good stuff. Fingers crossed the government don't do anything, because as Dick said right at the start of the show, if they do, it's going to just unwind everything the BOE have been trying to do. In any case, 3 very good summaries of what to look out for in the next 6 months. And that brings us to the end of the show. So let's have a look at the final scores. So, Arno, clearly that new haircut hasn't been a lucky charm for you this week. The odds-on favourite has romped home. Adam, congratulations. Clearly, turning up dressed like Ryan Paisley is the trick to winning Trading Blow.
There we go. Dress casual, think smart.
Is that what it is? Is that what you call it? Good stuff. Well, that brings us to the end of another show. Thank you to the gents for joining me a day early and moving their diaries around so I can go to Lord's tomorrow. Arno Venter from down in South Africa, Adam Linton from Newsquawk, and Dick Matthews down on the South Coast as well. Thank you also to our producer Kyriakos and his assistant Ricardo for bringing the show together. This feels like an Oscars acceptance speech, so we're going to end things there. Thank you all very much for watching. Leave a like on the video if you've enjoyed it, and we will be back again on Thursday next week.